All right, I feel bad for people that that are going to run with this headline, Steiner, that inflation's decelerating or disinflating. I mean, did it? I can't look at the numbers, but I'm pretty sure it hit our number.
Yeah, it was right in line with our number. So it was basically sideways at the headline, 3.7 versus 3.7. Actually, if you go out to the basis point, it accelerated a little bit, about 3 basis points. It came in ahead of consensus on the headline. Headline was looking for a 10 basis point decel. Like I said, it went sideways. On the core side, it was in line with expectations. So expectations were that core would slow from 4.3 to 4.1. That is what we got. We got 4.1. Notable call outs within the print. One of the big pieces was shelter remaining pretty hot. So shelter came down, but only by 10 basis points in rate of change terms year over year. So it had been 7.3. The September number came in at 7.2. Kind of interestingly, one of the big sort of subcomponents of that really helped to spike the number was hotels and motels. So that number went up quite significantly. Actually, it accelerated from 2.98% year over year to 7.33% year over year. So, big driver there. Outside of that, there was a pretty notable spike in insurance costs, basically household insurance costs. That drove from 1.45 up to 2.78. So that's a pretty big increase as well, obviously, sort of moving in the opposite direction there. So, yeah, I mean, look, overall, the market was looking for things to sort of be sideways to cooler. What they got instead was basically sideways to hotter. And, looking at the bond market, the very early kind of knee-jerk reaction, we got about a 7 basis point spike in both the 2 and the 10-year yields. That's giving a little bit back now. So we'll sort of see once we get into the, outside of, as you like to call it, the kiddie pool, the initial knee-jerk reaction. But yeah, I mean, I think for the most part, this is certainly more of a sideways type print. The other sort of thing to call out here is that month over month, if we look at all items, expectations were for 30 basis points. The actual came in at 40. So again, I think it's a pretty strong number. It's not like crazy strong, but when the market was looking for it to, be cooling a little bit further on the margin, and obviously it didn't, then that's really the regime we've been in, right? This sort of, reaccelerating environment since the July print. So no real change in that respect.
Yeah, the Ben Hunt and I talked about this a lot or throughout our conversation. Was the underlying, because he calls it fiat news, and Ben Hunt is one of the sharper and sharper people that you can sit down with, and certainly a thought leader on Wall Street. And he's got the courage to write against truth to power. And it's actually not. It will never cease to amaze me, and that's very sad and really a sad comment about our state of affairs in America, that it will not cease to amaze me how they try to spin this today. They are a thing, they being fiat news or the establishment. But I mean, it's what it is. I mean, I heard people yesterday, as soon as they saw it, they don't know it's $18 billion in CTA buying. They just think that somebody leaked the CPI was going to be lighter. That was going around yesterday in the last 20 minutes of trading. I mean, because people believe that, right? Because they believe that the plutocracy gets the information before we do, because they do sometimes, right? I mean, everybody knows that. And just look at the last jobs report when Biden essentially leaked it by telling you he was going to talk about how good the jobs report was without saying that with a press conference at 11:30. So people are willing to believe that because they really believe that the plutocracy exists, because it does. But this is a problem for the plutocracy. when the numbers and the numbers themselves and the bond market is trading on the numbers themselves, and the entire currency market, don't forget, which is a pretty sophisticated market and an older one than a lot of different single stocks that people own. It's just what it is. I mean, the Federal Reserve is, and the U.S. government, therefore, Janet Yellen in particular, they're losing control of the narrative because they're losing control of the bond market. And the bond market's trading with economic gravity. So it doesn't really matter to me. If the 2-year yield, Steiner, was up 2 basis points, if it was up 7 basis points, all that matters is that the floor is intact, right? The low end of the range. It literally went to the low end of our range for how many times? Like in the last year and a half, as the 2-year the range and bounced. And that's exactly what it just did. So however they want to try to manipulate the news today or try to trade bonds, it doesn't matter. It doesn't matter. The only thing that matters is getting the rate of change of the economic gravity right. And we're right. I mean, we're not getting inflation below 3.6% all the way into the end of Q1 of next year at least. And that's the call. I mean, the Federal Reserve needs 2. I heard people say that the core could be finally below 4. Well, no, it's above 4, and last I checked, 2 times 2 is 4. It's not. It's a 2-bagger, even if you're using that definition. So I don't know if you have any other comments on that. I got a couple minutes before I get to the office, but that's my summary of your summary, I guess.
Yeah, I mean, I think you sort of nailed it, especially toward the end there, where it's this classic thing, right? Where everybody gets so hung up on, the print, but the broader sort of context and backdrop here is that inflation is going to remain at this elevated level and is going to bounce around by plus 10 or minus 10, plus 20, minus 20 each month here through the end of the year, but it's going to remain at a level that's too high. And that's going to keep certainly the Fed far away from any kind of easing up of policy. And we're unquestionably in restrictive policy. So, the idea is that, we've gotten into this phase where it's sort of time underwater, right? So, the longer we sit here in a restrictive policy environment, it doesn't so much matter whether they do another quarter point or not. It's just that it's already restrictive. And as long as we sit there and are going to stay there for a long time, it's going to keep taking a toll, keep doing damage to the sort of, subsurface. So yeah, I think that's the main takeaway here is, don't get so hung up on the number. Just think more about, what is the outlook between now and the end of the year? We've got 3 months to go here, and the inflation backdrop is going to remain elevated. Therefore, the Fed's hands are going to be tied, and yeah, that's going to take us into 2024.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.